Revenue is the lifeblood of any business. It represents the income generated from the sale of goods or services. Accurately reporting revenue is critical for creating reliable financial statements. These statements provide a snapshot of a company's financial health. Investors and creditors rely on this information to make informed decisions. Accurate revenue reporting helps in forecasting future sales and earnings. This data is essential for strategic planning and growth. Understanding revenue is fundamental to grasping a company's overall performance and potential. Revenue provides insights into market demand and customer behavior. This information is valuable for making informed business decisions. By analyzing revenue streams, companies can identify areas of strength and weakness. This analysis enables businesses to adapt their strategies for sustained success. Historically, companies lacked a standardized approach to recognizing revenue. This inconsistency created confusion among investors and analysts. Different methods made it difficult to compare financial performance across companies. This lack of uniformity underscored the need for a unified standard. The International Accounting Standards Board, or IASB, and the Financial Accounting Standards Board, known as FASB, recognized this issue. They collaborated to develop a single, comprehensive revenue recognition standard. This collaboration aimed to simplify and harmonize revenue recognition practices globally. The result was a single standard, IFRS 15, adopted by both boards. This standard provides a principles-based approach for recognizing revenue. Its goal is to enhance comparability and transparency in financial reporting. The cornerstone of IFRS 15 is the 5-step revenue recognition model. This model provides a structured framework for companies to follow. By adhering to these steps, companies can ensure accurate and consistent revenue recognition. Step 1. Identify the contract with the customer. This step involves establishing the existence of a legally enforceable agreement. The contract outlines the rights and obligations of both parties involved. Step 2. Identify the performance obligations in the contract. This step requires identifying the distinct goods or services promised to the customer. Each performance obligation should be separately identifiable and measurable. Step 3. Determine the transaction price. This step involves determining the amount the company expects to receive in exchange for transferring the goods or services. The transaction price should reflect any variable consideration or discounts. Step 4. Allocate the transaction price to the performance obligations. If a contract involves multiple performance obligations, the total transaction price should be allocated proportionally. This allocation should be based on the standalone selling prices of each obligation. Step 5. Recognize revenue when or as the entity satisfies a performance obligation. Revenue is recognized when the company transfers control of the promised goods or services to the customer. This transfer of control can occur over time or at a point in time, depending on the nature of the performance obligation.